Some investors are attracted to covered call funds because of their high income yields and seemingly high risk-adjusted returns. However, the appearance of high income and high risk-adjusted return is the result of clever financial product design, not of actual improvements to returns or risk-adjusted returns. Covered call income is not really a net investment return. Covered calls are likely to perform poorly in the long run, and the risk-adjusted returns of covered calls are only attractive when risk is measured inadequately. Additionally, they tend to be less tax efficient and more expensive to own than simply investing in a portfolio of stocks and bonds. I'm Ben Felix, portfolio manager at PWL Capital, and I'm going to uncover the misleading claims that make covered call ETFs seem more attractive than they really are. A call option is a financial contract that gives the option buyer the right but not the obligation to purchase a security at a set price called the strike price. A call option that is in the money can be exercised to purchase the underlying security below its market price. A covered call means selling a call option on a stock that you own, receiving an option premium in return. In covered call funds, option premiums are usually distributed to unit holders, creating the appearance of extremely high income yields. But covered calls exchange option premiums for lost upside potential on the underlying shares. This means that the income they distribute is not really an investment return when total returns are considered. When an option is sold, the seller receives income from the option premium, but they also take on the liability that the option could be exercised, requiring them to sell the underlying shares below market value to the option buyer. This embedded liability can more than offset the option premium income, but that's easy to miss due to the mental accounting bias that causes many people to treat income and capital separately in their minds. This bias is common among income-oriented investors, and covered calls appeal to investors' biases and cognitive errors. In reality, we would not expect covered call strategies to have higher risk-adjusted returns than their underlying assets unless options are overpriced, making the income yield figure that people often get so excited about somewhere between irrelevant and overstated. The measure of risk matters a lot in making judgments about risk-adjusted returns. Options affect higher moments of the return distribution, including skewness and kurtosis. A common measure of risk-adjusted returns is the Sharpe ratio, the ratio of an asset's excess return over the standard deviation of the excess return. This metric is inadequate for assessing the performance of strategies containing options due to their effect on the shape of the distribution. The Sharpe ratio follows Harry Markowitz's mean variance framework, which assumes that the mean and standard deviation of single period returns are sufficient for evaluating the relative attractiveness of investment portfolios. If you imagine a normal distribution, which is fully described by its mean and standard deviation, the distribution of outcomes will be symmetrical about the mean. Writing call options slightly improves the left tail by the amount of the option premium and completely cuts off the right tail at the option strike price, reducing standard deviation while increasing skewness. The effect is a mechanical increase in the Sharpe ratio, but skewness is another form of risk that investors care about, so ignoring it in the evaluation of risk-adjusted returns for a strategy that we know has a skewed distribution simply does not make sense. Other evaluation metrics better suited to assessing strategies with skewed distributions demonstrate that covered calls will tend to underperform their underlying assets even before fees, costs, and taxes are considered. This should not be a surprise given how important the right tail of the distribution, which is cut off in a covered call strategy, is to stock returns. Investment managers may game, whether intentionally or not, you can be the judge, common performance evaluation metrics like the Sharpe ratio by using options and other complex strategies. This gaming works even in the face of high costs. Metrics like the aptly named manipulation-proof performance measure have been developed specifically to be free from option-related manipulation, and through this lens, covered calls are dominated by less complex strategies. Another way to explain all this is that any abnormal risk-adjusted performance of covered call writing is largely driven by the disregard of skewness. To be fair, even if an objective assessment suggests that covered calls are suboptimal, the strategy may be useful for behaviorally biased investors who rely on the mental separation of capital and income to determine their spending and want to spend down their portfolio aggressively. My comments so far have mostly ignored fees, costs, and taxes, but these are major considerations. Due to their high distributions, covered call funds will typically be less tax efficient for taxable investors than the underlying stock index, and their fees will tend to be higher. Using XYLD as an example, the fee to own the fund is 60 basis points compared to 10 basis points for SPY and 3 basis points for VOO. Products implementing covered call strategies will also tend to have higher implementation costs than simple index funds investing in the same underlying assets. Taking a step back and looking more broadly at a sample of mutual funds, in general, live funds using covered calls tend to underperform, measured by excess return and the manipulation-proof performance measure. It is true that in a flat market, covered call strategies will outperform since the option premium income will not be offset by foregone appreciation in the underlying securities. An investor who believes that the market or a segment of the market will be flat or slightly negative may implement covered calls to generate returns. But market timing is hard. It's not possible to predict a flat market, and covered calls introduce the possibility of missing out on positive returns which, over time, tend to outweigh flat and negative returns. Covered call funds are often sold as high-income strategies with attractive risk-adjusted returns. Examined with appropriate consideration for total return and assessment tools that account for skewness in the distribution of returns, they are neither high income nor do they have attractive risk-adjusted returns. They appeal to the behavioral biases and cognitive errors of investors, which, in some cases, may be fine. But in general, and especially for investors who want to behave rationally, covered calls are an objectively suboptimal strategy most of the time. Thanks for watching. I'm Ben Felix, Portfolio Manager at PWL Capital. If you enjoyed this video, please share it with someone who won't stop telling you about their covered call ETFs. Before you go, I want to share a couple of short clips from Mayer Statman and Cam Harvey, two giants in the world of academic finance, discussing some of the topics that I covered in this video. Both clips are from episodes of my podcast, the Rational Reminder Podcast. That's a really nice way to explain it from the other direction. What about strategies like covered calls and structured products? Why are those so attractive to normal investors?
Well, they're attractive because of the way they are framed. People hate losses, and they hate the prospect of losses. And so, let's say that you buy a share, and a broker says to you, why don't you do covered calls? Why don't you sell call options against it? And they say, look, in fact, I take that from a manual for brokers by Gross. And what he says is, you're going to have in a covered call three sources of profit. First, you still hold the stock, so you'll get dividends. That's one source. Second, you'll get the premium from selling that call. That's another source. And third, because you're going to write that call with an exercise price higher than the current price, you will have the third one, because if it is called, then let's say that the exercise price is 55 and the stock is at 50, you'll still get that 5%. $5 rather, between $50 and $55. And then he says, what you're going to lose are those uncertain things that happen if the price goes beyond 55. But of course, if you find that the stock price has gone not to 55, but to 75, you're going to again feel like an idiot with regret. And so what people are kind of fooled by this framing of three sources of losses, and they don't realize that when they buy a call, somebody is selling that call, and that somebody might not be stupid, that somebody might know something that you don't. And so it is really, again, rationally speaking, it makes little sense. But behaviorally, normally, it does make sense. And so this is covered calls.
Do you think that's being used enough in practice? Like, we still hear about mean and variance a ton, and not as much about skewness.
Yeah, it's remarkable to me that it's been so many years and we still make the mistake of operating in like a mean and variance world. Or people will take a look at different investment strategies and pick the one with the highest Sharpe ratio. Well, let's take a step back. the high Sharpe ratio might be a strategy that has got a giant downside. So it's got negative skew. And then the lower Sharpe ratio maybe has the positive skew. So the variation in the Sharpe ratio is purely explained by the risk. So this is really important because often people will claim that their trading strategies got like some alpha. And then you ask them, well, how are you measuring that alpha? Well, we're using the capital asset pricing model. Well, that's only appropriate if you only care about mean and variance. So you could have, a giant downside, and that's generating on average higher returns, but it's purely a risk. Indeed, I've got an exam question that I've used, and hopefully my students don't listen to your podcast. And it's a true story. That a student gets me on the phone, an alumnus, so graduated a number of years ago, and wanted to use some of my materials, was seeking permission. And I said, well, what do you do? And they said, well, we're incredibly successful. We're close to $1 billion AUM, and the strategy is really simple. All we do is we buy the S&P 500. Nothing fancy, but then we consistently write out of the money put options, and then we've done like 200 to 300 basis points of alpha every year, and the fund is growing. So I have had many students. I thought this might be one of my students, and I said, you didn't take my course in asset management, did you? And they said, no, I didn't take it, but that was a mistake. I said, well, I know you didn't take it because you actually have zero alpha. What you're doing is just increasing the risk of the portfolio. What you think is alpha is just a compensation for taking risk. And at some point, there's going to be a drawdown in the market. And you're going to greatly underperform.